The most important implication of a high and rising burden of debt is it puts downward pressure on economic growth and all the various components thereof, like productivity, like job growth. So there were so many forces that kept inflation down, that long-term secular move down in interest rates. And I think most of those secular forces have either ended or in some cases have gone into reverse. I get a lot of questions about, isn't the market doing well because it anticipates, whether it's because of political pressure or not, that the Fed is going to start cutting imminently? I think it's the opposite of that. I think part of the reason why the market's doing well is because the Fed is not cutting. Of the top 10 best performers in the S&P this year, none of them are in the Magnificent Seven. Top 10 best performers in the NASDAQ, not only are none of them in the Magnificent Seven, I bet you most people have never heard of any of the companies.
Hi, Liz Ann. Thank you very much for joining us again.
Oh, guys, it's so great to be here. Thanks for having me. Really appreciate it.
We're going to cover a lot of ground with you today, and some of this is going to be based on the second half outlook piece that you guys just put out at Schwab. Some of it is also going to be based on some commentary posts that you post on X. So Liz Ann's articles can be found on the Schwab site under the market commentary section, and you can also follow her on X. It's at Liz Ann Sonders, where she stays pretty active and transparent. So we asked that our listeners, go follow her. She's getting close to the 500,000 mark, which is a big accomplishment, and maybe we can push you over that edge.
Well, thank you. I hope so too. And by the way, just public service announcement. Make sure if you're going to follow me, you follow the real me, because I've had hundreds and hundreds and hundreds of imposters on X and across many other platforms. So make sure it's the real me.
Yeah. Okay, so let's start off with sort of what's transpired in the markets over the past few months and sort of get some of your thoughts on retail trading and market dynamics. And one of the things that you've kind of said in some of your commentary is, looks like the retail traders' fingerprints are all over this recent market move since the April lows.
Yeah.
So just can you talk about what you're seeing in terms of positioning and also what that tells us about the market dynamics in general?
Sure. So if you think about the first week in April, particularly the period from April 2nd to April 9th, I think one of the ways to frame that unique period of time is not based on the news that came out over the course of that week, meaning the April 2nd announcement of reciprocal tariffs up to the April 9th announcement of the 90-day delay of those tariffs. On an ongoing basis still, we can't attempt to gauge in advance what the next tariff-related announcement is going to be, the manner in which we get that information. But what we can do is we can analyze the setup for the market. We can look at sentiment conditions, technical conditions, breadth conditions, and see whether maybe there's more of a bias to the upside or downside, depending on whatever the catalyst is. And I think heading into the April 2nd reciprocal tariff announcement day was one of a bit of complacency. I think the consensus was sort of gelling around what was going to be announced, being the 10% across the board tariffs. The market was not washed out from a breadth or a sentiment perspective. So when that news came out and the big, cardboard banner was held up with those reciprocal tariffs, the setup was one of a pretty significant amount of downside, exacerbated, of course, by the fact that it wasn't just equities going down. It was bond prices going down via yield shooting up and the dollar going down. So we had this week where we were acting like an emerging market. Fast forward only 1 week later on April 9th, that was that crescendo low intraday. It was an incredible reversal day. And the setup heading into what was the, 11 o'clock in the morning Eastern time announcement of the 90-day delay of reciprocal tariffs was one of the complete opposite of complacency. Sentiment was washed out, breadth was washed out, market was way oversold. So the setup was for, even with only incrementally positive news, we kind of shot higher. Fed by retail traders who still very much have the buy the dip mentality, FOMO. And then you look at the period since then, you look at the cohorts that have been outperforming, the baskets of stocks. Goldman Sachs has some of the best baskets out there. And the big outperformers from that April 8th closing low have been non-profitable tech stocks, heavily shorted stocks. They even have a basket that's retail favorites. So that is where you have seen the lift which is why I say retail trader fingerprint. And particularly given that we've seen most shorted stocks do well, the retail traders push of this market higher kind of force some repositioning on the part of institutions, not to aggressively risk on by any means, which is why I think the pain trade may still be higher. We can go on lots of different threads on that, but that's how I think about the last 3 months of market action.
Yeah, I think that the chart will stick in here, which is that Ned Davis research crowd sentiment poll sort of shows that big decline and then that, waterfall decline and that big move off the low. And it's in, you can talk to it, Liz Ann, sort of what we're looking at here with that chart and sort of how investors should interpret that. And then maybe talk about
Sure.
the pain trade a little bit too.
Yeah. So the NDR's crowd sentiment poll, they've been tracking that for decades. And what I like about using that as an aggregate way to look at sentiment is because it's an amalgamation of a number of different sentiment indicators. And what I also like is that amalgamation is across both attitudinal measures of sentiment, so survey type sentiment indicators, like probably the most popular one being American Association of Individual Investors, the AAII weekly poll. But then there are behavioral measures as well, things like, RIDEX flows in and out of the bull and bear funds, the equity only put call ratio. So those are behavioral measures. So I like the combination. And what I'm sure the data is that you're going to show, assuming you have the embedded table associated with just the chart, is it's not really an extreme of sentiment, either on the despairing end of the spectrum or euphoria end of the spectrum, that sends sort of a contrarian market message. The best performance historically has come after you've kind of seen sentiment bottom out in that, very pessimistic zone and then start to move back into neutral. And what's really important about data like this, and I do this across all indicators that I look at and track, is it's not just the level of any of these indicators, it's the direction of travel. So being in the neutral zone in an indicator like that, you can't just look at that in level terms and say, okay, what has the market done historically? Because there's a huge difference between when you're coming up from extreme pessimism into neutral versus if you're coming down from extreme optimism into neutral. It's the former. It's that lift off of despair, starting to get a little bit more optimistic. That's the best background condition for the market. Now we're kind of heading back into extreme optimism territory. So that'll be on watch.
I love the directional orientation. I think that's a perfect segue into what I want to ask you about next, which is let's talk about policy instability and specifically the tariffs. You've been really great at highlighting that it's like a building complacency around the tariff issue. And I'm curious what specific risks you're watching here because it's evolving fast. This is July 22nd. We're getting some consumer earnings. The conversation's changing. What are you watching?
So the problem, I think, is that this has been a perpetual moving target. There was the April 2nd announcement, but the further announcements, the delays, the backtracking, not to mention some of the moves by our trading partners to sort of combat those tariff announcements, that it's not like the switch was turned on and we can do a before and after assessment, whether it's tied to the impact on corporate earnings or profit margins or the impact on inflation metrics or how companies are navigating. It's still a bit of a moving target. And what you're hearing from companies pretty consistently is that if they knew what the playing field was and the goalposts weren't continually moving, they'd be able to ostensibly figure out how to navigate this. Now I think we're sort of in this moment of status where companies, other than maybe in the AI space from a spend perspective, have put themselves in a bit of a timeout until they have a better sense of the playing field. And that seems to be the right move. Frankly, it's also similar to the Fed that has kind of put itself, at least for now, in a timeout because of this uncertainty. The last thing I'd say is this notion that I think has been embedded into sort of the zeitgeist or the psyche of investors that because we haven't seen a materially significant negative impact on inflation. And we haven't seen a big hit to the economy either via the labor channel or otherwise, that we're now in a sort of nothing to see here, limited impact. I think we still have these impacts yet to come. We're right now at about a 15% average effective tariff rate. If everything else that's currently on the table, things that have been proposed, sectoral tariffs, and not including any retaliations, that could go to as high as a 35% effective tariff rate. Even at 15, we're talking, beyond Smoot-Hawley level tariffs. We know that a lot of companies front ran the initiation of many of the tariffs that are in place now. So they built inventories at a lower cost basis. And to some degree, they're in this experimentation mode as in terms of, will they eat some of it in the profit margin? Will they pass it on to consumers? And by the way, as a reminder, I can't believe how often I have to remind people of this. Tariffs are paid by the U.S. companies importing the goods from the countries that are being targeted. Shame on the shorthand and shame on the voices that say, China's paying us more in tariffs now, or the EU is paying us more in tariffs. The tariff is paid by the U.S. company. Now, a valid debate is who ultimately bears the cost. And there's this idea that the targeted country, the exporter to the United States, will adjust their prices to offset some of the tariff costs to U.S. companies. That isn't happening. So that leaves the other two options: pass it on to the consumer or eat it in your profit margins. And we're only now starting to get meat put on the bones of that. And second quarter reporting season, which we're in the midst of now, I think will help to clarify what that bias is going to be. More likely than not, based on history, they'll try to pass on as much as they can to the end consumer.
So knowing that people watching this, they don't want to feel like they're in the totally complacent camp. They don't want to feel like they're just waiting to see what happens next. You've written about the instability versus uncertainty framework a little bit here. What can we do that's actionable? How can we think about this, especially when there's kind of one decision maker who seems to be driving any breaking news day to day?
Well, I certainly wouldn't try to trade around the anticipation of what the next post is going to be or news item is going to be. I think that's a fool's errand. Frankly, I think trading around a future forecast, I think, is fraught with peril anyway, particularly if the idea is all or nothing, get in, get out. I'm often asked, are you telling your investors to get in or get out? And I have a love-hate relationship with the question. I hate it because I think it's a terrible question, but I kind of love it because I get to explain why I think it's a terrible question. It's really simple. Neither get in nor get out is an investing strategy. It's just gambling on not just one moment in time, but two moments in time. And that's not how we should invest. But there are things that we can do to sort of stay in gear without having to anticipate what the next policy-related announcement is going to be. One of them is sort of your classic discipline of rebalancing, but there are some adjustments one can make to a rebalancing strategy, assuming it's right for you as an investor, which is a lot of investors or a lot of programs that have rebalancing as part of them do it based on the calendar. And our suggestion is if you've got that flexibility, make it portfolio-based rebalancing or maybe volatility-based rebalancing. So the timing of trimming back winners, adding to areas that have underperformed is going to be dictated by what's going on in your portfolio, as opposed to waiting to the last week of the quarter or do it on an annual basis. And that helps you stay in gear by adding low and trimming high, a version of buy low, sell high, but not all or nothing. And then, of course, the tried and true diversification, which the component of that's important is not letting your portfolio become as concentrated as many of the indexes that are very popular benchmarks for us and we're passively attached to, like the S&P 500, and take advantage of some of the shorter term swings in the market to make sure you are not developing that concentration problem in your own portfolio.
Well said all around. Let's talk about another thing we don't have much control over, but we're all struggling to digest. This big, beautiful bill. I mean, this is why we follow the Twitter feed of yours. We want to see those debt concerns, the potential bond market constraints, all the follow-on ramifications of this. How are you digesting this piece of legislation?
Well, what we know now, and based on, nonpartisan CBO and other institutions of the like, none of them have come out and said this improves our deficit or debt. It's somewhere in the high twos, meaning, $2.8 trillion up to maybe 3.4 trillion is kind of the range that I have seen in the aftermath of it becoming law in terms of the 10-year window add to the budget deficit, which of course debt, federal government debt, is the cumulative effect of running budget deficits. So that doesn't improve either. What's interesting about this whole topic of the budget deficit and debt is that even before the bill got passed, even before a year like last year, where we saw the interest costs on debt leapfrog what we spend on defense. And that was sort of an important actual thing that happened, but a psychological thing because of hundreds of years of books being written about fall of empires happening when the cost of servicing your debt exceeds the cost of defending your country. So it amped the wattage a bit on this topic. But even before all of that, the investor class has cared really deeply about this. There's not a client event that I have had in the last 5+ years where the first question that's asked isn't something about the deficit and debt. So I think the investor class cares deeply about it. I guess the problem is that the average constituent may care about it in the abstract, but they don't tend to vote based on it, which is why this is the ultimate game that both sides play very well, which is kick the can down the road. And the real kind of solution to this problem is to have the growth rate in debt be lower than the growth rate in the economy, because then mathematically you start chipping away at the problem. That clearly has not happened. But we're at an interesting point here because I think the wattage of the spotlight turned on this has been turned up yet again. And now constituents are starting to grasp the importance of considering the implications of this. The most important implication of a high and rising burden of debt is it puts downward pressure on economic growth and all the various components thereof, like productivity, like job growth. So that's the thing in the here and now. We don't worry about defaulting. We don't worry about the dollar imminently losing its reserve currency status. So we sort of table those concerns, but that putting pressure, that crowding out effect, putting pressure on growth, that's in the here and now. And that's not just a US phenomenon, that's a global phenomenon.
Are there things in the bill that could be inflationary? Like I'm thinking, on the one hand, there seems to be a lot of pressure coming from a lot of different directions on the Fed possibly easing, but they may be in a pickle here with some of the things in the bill actually, resulting in possibly higher inflation. So I'm just wondering, are there anything that sticks out in the bill?
Well, I don't know that much on the tax front would be considered newly inflationary because most of what the tax side of this bill was an extension of 2017 tax cuts. So it kind of keeps things at a relative status quo, other than things like tax on tips, which is, by the way, a lot more articles coming out on just how difficult it's going to be to actually quantify that and how you calculate that and how you decide, what is a tip and what is not and reporting thereof. So it's a bit of a logistical can of worms that has been opened up. Continued cuts, and this is broader than just the bill, continued cuts to government spending and the federal workforce, that all else equal is more disinflationary. Release of some of the regulatory constraints, I think, again, all else equal, is positive for things like business investment. But then you've got that tariff-related constraint on business investment. So there's so many cross currents here. I think that we're in a backdrop where inflation is likely to be higher, certainly than it was during what we would call the Great Moderation era, and not just a function of tariff policy. I think a lot of what drove the Great Moderation era from the late 90s to the early part of the pandemic was massive globalization and us becoming energy independent and free trade. So there were so many forces that kept inflation down, that long-term secular move down in interest rates. And I think most of those secular forces have either ended or in some cases have gone into reverse. So I actually think from an inflation backdrop perspective, I think we're in a secular environment that probably looks a little bit more like the period between the 60s and the 90s than the Great Moderation era. And that has lots of implications for markets and investors.
One of the things I know when you look at inflation, you kind of emphasize or talk about trying to look beneath the surface on these
Yep.
key indicators like CPI and PPI. Is there anything that you've seen recently that you think sort of stands out to you, or maybe that the market might be missing a little bit here?
Sure. So I think a natural way to parse inflation data, particularly a metric like a consumer price index, which is the most popular, even though it's not the Fed's preferred model these days, is to separate out goods and services because it's in the goods area that you are starting to see the tariff impact. But even within the goods side of inflation metrics, you can separate that out further into those goods that are not directly impacted by tariffs and those that are directly impacted by tariffs. So, number one, if you look at that granular level, you cannot deny that tariffs are having an impact because those core goods within the goods side of inflation metrics, that's where you're seeing elevated price pressures. On the services side, even though not directly impacted by tariffs, we also need to parse through that too, and also understand the differences from one inflation metric to another. So CPI is the one we're all familiar with. That has a huge shelter component to it. A lot of those shelter components, rent of a primary residence, owner's equivalent rent, have actually been disinflating, kind of offsetting some of the upward pressure on the goods side. But now we're getting to a point where that has the potential to reverse. So we now may not be in this situation where we've got brewing goods inflation, but offset from better services inflation. We've got to see where we may be starting to turn back up on the services side. And then the feeders of the various inflation metrics into the PCE, which is the Fed's preferred measure. But last thing I'd say about kind of bifurcations within inflation data that may be just as relevant as goods versus services is discretionary versus non-discretionary. So discretionary items would be the wants items within a measure like CPI. Non-discretionary are the needs. Well, the non-discretionary inflation is running 2x the discretionary inflation. And it's another example of what's increasingly becoming kind of this K-shaped backdrop, the haves and the have-nots. And we know that higher income people are in much better shape. You see that in the consumer confidence and consumer sentiment, where you now have kind of record spreads between the perceptions about the economy of low income versus high income. And then, of course, low income is hit even more by virtue of the fact that the inflation rate in the needs components, which is a much larger portion of their consumption basket, is running at twice the rate of the discretionary component. So lots of fine-tooth combing, I think, is necessary. And I'd apply the same thing to labor market data. Don't just look at the headline of payrolls at the next jobs report and the headline of the unemployment rate and, say, okay, I now know what the labor market is doing. You really have to dig inside these numbers.
So do you think that the tariff impact will show up sooner in these inflation readings versus margins? Would that be your, I guess, hunch on that?
I think it's probably going to be a combination. And let's call it at the end of last year, coming into the beginning of this year, when the consensus was for, 14 or 15% earnings growth for calendar year 2025. That was predicated on record-breaking profit margins. That's not the consensus anymore, obviously. And even though first quarter earnings were much stronger than what was expected, there's been no extrapolation into the remaining 3 quarters of the year, including second quarter, which is being reported right now, based on concerns about profit margins. So I think we are not yet fully seeing it in prices, even just anecdotally. If you sort of pay attention to the headlines, the commentary coming from companies, what companies are saying during earnings conference calls, we're starting to get a little bit more precision around guidance. And I don't mean companies are now saying, yes, we can provide precise guidance. Here's, you're going to be off by 3 cents per share of 3 quarters from now. That's still a very murky situation, but starting to be forced to answer questions from analysts that cover their stocks. How much are you planning to eat this in your profit margins? Have you started to pass this on to consumers? Is it sticking? Et cetera, et cetera. But also a lot of companies, maybe for somewhat obvious reasons, when announcing that they're raising prices, are not using the word tariffs. I think it was Subaru that came out and said, we're raising prices because of broad macro issues or something like that, AKA tariffs. But I guess maybe you don't want to run the risk that you get, your wrist slapped by the administration for blaming, price increases on tariffs.
So you've said before that, and this goes back to these times, that unstable is a better descriptor than uncertain for this current backdrop that we're in. Can you explain that distinction a little bit more and why it matters for both businesses and us as investors?
Sure. And some of it is just kind of having fun with the semantics of the word.
You're allowed to have fun? I thought
Yeah,
this industry
I'm
was
allowed to have fun
anti-fun.
every once. That's
Okay.
why I name all my research reports with rock song titles, just add a little fun into the mix.
We love that.
Well, thank you. Yeah. So another reason why I decided to sort of express that view that maybe the better unword is unstable, not uncertain, is sort of my lifelong. I'm almost 40 years doing this, and that old adage of the market hates uncertainty, is as old as we've had markets. And I've often sort of giggled in my head when I hear somebody say that, because it suggests that there are times where things are certain. Like there's always uncertainty. That's just par for the course. And I think it's the instability that maybe is a better descriptor in the current environment, especially as it relates to tariffs. Because this isn't just, here's what we're thinking about, maybe we won't do it that way. This is like, these are in place, then they're going up, then they're being delayed, then they're being taken off. It's unstable. So, I talked a bit before about the playing field. I think companies are still trying to figure out, is it a football field? Is it a soccer pitch? Is it a basketball court? Is it a pickleball court? Let alone maybe some of the end zones and the goalposts are being moved. So it's the instability that has put a bit of a freeze on companies' longer-term forward-looking investment plans, CapEx plans, hiring plans. Again, maybe with the exception of spend on AI.
What's interesting here is I was already thinking I wanted to ask you about quantifying some of this, or how do you put metrics on it? But I think what you just said there, using the sports analogy, really is you're looking for people explaining this nuance with some actual description of like what the high side and the low side looks to them. Is that a fair characterization here?
Well, I think since we're in second quarter reporting season, I think that at least analysts are trying to force a bit of that on companies. And there have been a number of companies that have gone from a few months ago withdrawing guidance altogether. I think a couple of airlines, and I don't cover individual stocks directly, so I'm speaking more broadly. But I think it was a couple of airlines that had pulled guidance altogether. And then more recently, and I think one of the major airlines didn't pull guidance, but they did sort of scenario analysis. It was a pretty extreme range. So I think that maybe the best that companies that are in the crosshairs here, that are most directly impacted by tariff policy, in the absence of precision guidance, given the unknowable that is the path of things like trade policy, is they may be forced by their analysts to at least try to scenario analysis and provide a range. We know what the average effective tariff rate is right now. So at a snapshot moment in time, you maybe can do an assessment of what that means to your own margins, what your pricing power is. And then if we were to get to the extreme of what has been floated and proposed, the sectoral tariffs, the additional tariffs on the the EU, the 15% going to 35%, that's a pretty Armageddon-like scenario. But I think that would be one way for companies to establish kind of a current case and worst case range. I don't know how many companies are going to come out with some sort of extreme best case, to the extent best case is never mind, all tariffs are coming off. I don't think that might be best case and by some's view, but that's I don't think that should be in anybody's cards.
You have talked a lot about the labor market dynamics, and it's remained pretty healthy and strong. Although I think just recently, and you have a chart on this, non-farm payrolls have been showing some softening. So, what would you say would be the biggest risks to the labor market right now? They're sort of hard to see, but there has to be something that could, sort of rock the boat here.
Yeah. So downside risks, I think, would be that we break this stalemate right now of low hiring, low firing. So companies haven't been announcing big layoffs, but they've also held back on any significant hiring. So we're in this sort of period of status right now. Something breaking such that either in the interest of trying to protect profit margins or demand damage associated with tariff policy, or just a general weakening of the economy, income growth weakening, that you then kick in a more aggressive sort of layoff cycle. And so the metrics to pay attention to gauge whether that is happening, again, are sort of slightly subsurface indicators. So initial unemployment claims, which of course are reported on a weekly basis, those continue to trend at a very healthy level. They've had a couple of moves up, but then they've rolled back over again. In the case of initial claims, rolling back over and moving down again is a good thing, as a reminder. But continuing claims are at a cycle high. That suggests that people who have lost their jobs, have had to file for unemployment benefits, are having more difficulty finding new jobs, so they stay on unemployment insurance for a more extended period of time, hence cycle high and continuing claims. You can also see it in terms of private sector versus overall payrolls. Private sector payrolls, that's where we've seen pretty meaningful deterioration. You've also got to look at some of the adjustments that the BLS makes. They make seasonal adjustments. There was some questioning about maybe faulty seasonal adjustments in the most recent jobs report, because that was for June and it showed a big increase in health and education jobs. You don't tend to see a big increase in education jobs in June at the start of the summer. So a lot of kind of flag waving when that number came out and said there may be something awry with the seasonal adjustments. And then the BLS also has a birth death model that they apply every month. And that's not the birth and death of people. It's the estimated birth and death of businesses. And notoriously, this is not a new phenomenon. When you're at inflection points in the economy, when you're going from more of an accelerating growth phase to a weakening growth, even if it's heading into nothing more severe than a soft landing, but weakening growth, you tend to see the BLS overestimate business births and underestimate business deaths. So that is probably coming into play, sort of flattering these payroll numbers. And then as it relates to the unemployment rate, you've got to look at things like long-term unemployment. You've got to look at temporary help versus permanent layoffs. You've got to look at hours worked, because in this low hiring, low firing mode, one way companies can maybe bring down some of their labor costs is to shrink the hours worked as opposed to laying people off. That's where we've seen some weakness. So again, I think the most important tool for analysts or even just market watchers to have these days is that fine-tooth comb.
Do you have any thoughts on, and this is more headline related, but just stick with me here. Let me see if I can. So on the one hand, the crackdown on immigration and how that's affecting sort of the flow of workers and labor into the country. And so that would seem like that would be potentially bad. I'll let you sort of comment on that. But then on the other hand, it seems like, and I don't know if you have this number or if anyone has this number, I think it'd be interesting, like how much companies have committed to invest in the United States, and what that might mean. And that maybe is more a specific segment of labor, like maybe construction workers or industrial workers, or maybe high-end engineers. I don't know exactly what goes into building all these things, but so I'm just wondering on those two sort of points, do you have any thoughts on how those might play into the labor market?
Yeah, I mean, the immigration impact and the significant sort of compression in the flows of immigrants coming to the United States, not to mention the deportations of those already here, leaving the politics aside and the emotion associated with the politics of this, all else equal, that puts downward pressure on growth, downward pressure on productivity because you're impacting the supply of labor. And ultimately, in its most simple form, the definition of GDP is labor force growth times productivity. And if you've got downward pressure on both labor force growth and productivity, the math does not mean higher GDP. So I just wrote, I guess you would call it an op-ed. I'm a column contributor from time to time with the Financial Times, and it was just, I think, maybe 2 weeks ago, they published a column of mine that just goes into the facts around immigration, not the politics of it, not the emotional side of it. And that's something with which we're starting to contend. It's working its way into the labor force participation numbers that you get out of the BLS during, when we get the monthly jobs reports. We know the impact it's already starting to have on those industries where the immigrant population is a much larger share of the industry. You mentioned construction, obviously agriculture, but also in hospitality, in many specific healthcare fields. We're only at the beginning of seeing the impact of this, but it has to be part of the math that goes into every component of economic growth. And again, all else equal, it's another thing that looking ahead is likely to put some downward pressure on economic growth. The inflation impact, you could argue there's sort of push and pull in both directions. I don't want to say, and they'll just even each other out and we won't see an immigration impact on inflation, but there are some disinflationary aspects to the constraints on immigration, but also inflationary aspects, especially in industries where more native-born workers are going to be needed and companies are likely to have to pay a higher wage in order to attract those workers than they were paying many of the foreign-born. So we're going to continue to have to parse this stuff because it is a bit of a push and pull in terms of that. Is it inflationary? Is it disinflationary?
Well, speaking of jobs that are, I'm going to say, somewhat hard to fill and probably nobody wants right now, Powell keeps being threatened as being ousted. We don't know if he's sticking around or what's exactly going to happen if you read the headlines. What's this whole Powell conversation mean, both for Fed independence and, I mean, what would early removal actually even mean? How do we think about that?
It doesn't look like the president has the authority to fire Powell. Supreme Court essentially said that, except for cause. We know what that potential cause is being billed as a possibility with the renovation of Fed headquarters. Guys, what's really been surprising to me is the last few days, call it the last week. Seems that there's a few, well-known people out there that have not been on the semi-official shortlist that in different ways may be vying for the job. And I'm not going to name names, but a lot of attention being grabbed by some additional voices saying the right thing would be for Powell to resign, with different rationales behind that. But first of all, I don't think Powell will resign. I don't think he should resign. And I frankly have an out of consensus view about this as it relates to the market. I get a lot of questions about, isn't the market doing well because it anticipates, whether it's because of political pressure or not, that the Fed is going to start cutting imminently? I think it's the opposite of that. I think part of the reason why the market's doing well is because the Fed is not cutting. A combination of because they're not bowing to political pressure. Oh, and by the way, neither side of their dual mandate suggests that they should be cutting. Financial conditions are easy. The unemployment rate is steady, actually has been coming down. Inflation is still above their target. So the conditions just don't suggest that they should be easing. I think that has also meant relative calm in the bond market. So this idea, I just had a friend over the weekend say, my biggest problem, he's a business owner, is the cost of money. And so he said, I'm sorry, I'm on the side of get rid of Powell and force the Fed to lower rates because the cost of money needs to go down. I said to my friend, I understand your business enough to know that you're not borrowing at the Fed funds rate. You're borrowing at yields that are tracking more, if you're going to use the Treasury curve, the 10-year Treasury. And there's a distinct possibility that if the market feels the Fed is prematurely lowering rates, doesn't have the incentive to do that based on their mandate, that you could have a repeat of what happened as recently as last fall, when the Fed cut by 100 basis points and the Fed funds rate and the 10-year yield over the same exact span of time went up by 100 basis points. So this idea that if we just get the Fed to cut rates, that eases borrowing costs for companies and brings mortgage rates down, suggests a misunderstanding of what rate it is that is tied to borrowing rates for corporations, for individuals. And again, I think part of the reason why the market has done well is because the Fed doesn't have the conditions that suggest easing. So again, somewhat out of consensus view, but I'm sticking with it for now.
It's really important, I think, to acknowledge that. And it's also important to acknowledge, we talk about markets hating uncertainty and all the problems with that phrase, but even inside of the Fed, assume Powell's in place, internal to the Fed, you have a lot of differing opinions right now.
Right.
And I think that's both healthy and normal and constructive for businesses to know there's nuance, because I love the point you just made, work with a lot of business owners, and it's like, your spread is not the Fed funds rate.
Right.
Please understand,
Yeah.
This is an important function of capitalism and creating money. So what do you say to the Fed and this seeming that they're divided? What do you think the Fed should be doing next?
I think right now the Fed is doing the right thing, which is they put themselves in a timeout, and they're waiting to see what happens with the data. Right now, neither side of their mandate says they should be doing something. Our assumption is that they will have the impetus to ease. We're sort of penciling in one or two cuts this year, but a data-dependent Fed with neither side of their mandate suggesting they should move, it's going to depend on the data. But what I do expect is that there's going to be more dispersion in terms of the views and the outlooks of the various members of the Fed. You're already seeing that. So every other Fed meeting, we get the update to the summary of economic projections and the update to the so-called dots plot. That's not happening at this month's meeting. That happens at the September meeting. But what you're seeing as you go out into 2026 and 2027, there's a wider spread from upper end to lower end. So much more divergence in terms of opinion. And that's okay. That's, I think, reflective of just how uniquely unstable or uncertain the backdrop is. But it's also a reminder that the C in FOMC stands for committee. It doesn't stand for chair. So this idea that you just oust Powell and you put someone in that is going to be more aligned with what the administration wants, that everybody is just going to get in line behind that person, I disagree with that notion. What will be interesting about this month's meeting is whether we have a dissent or two, and it wouldn't surprise me at all if it wouldn't surprise me at all if there was no decision, meaning the Fed doesn't cut rates, but that you have maybe a couple of dissenting opinions in favor of cutting rates. So I think that divergence of opinion probably doesn't ease in the near term.
One of the charts from your papers shows, and this is related to market concentration, how well or good the performance of the Mag 7 was in 2024. And fast forward to this year, and it's pretty much three stocks, NVIDIA, Microsoft, and Meta, that are all up over 20%, where the rest of the Mag 7 is sort of, low returns or maybe even negative returns.
Yep.
So how do you think about it's been hard as investors, the Mag 7 is where everyone's want to be, but just talk about like concentration risk in the market and sort of how investors should think about this.
I I've asked a simple question to uh, quite a large group of investors over the past, I don't know, month or so. I decided to do my own little bit of an anecdotal survey, and for the most part, these are not mom and pop investors. They're on the arguably more sophisticated end of the spectrum, and I've asked if they recall what the moniker, how that came about, and why those 7 stocks were kind of chosen. And some of the answers, they're the direct AI plays, or um, they're like a component of what was the mega cap 8 that also included Netflix. But most of the time, they say, well, for a while there, they were the 7 best performing stocks. And even when collectively they were all doing well, they've never been the 7 best performing stocks. At the outset of that label being applied, they were the 7 largest stocks. But there's a difference between being the best performer and being the biggest contributors to cap weighted index returns. And that's what I think a lot of investors are missing in this view that the only way to do well is to be concentrated in those names. And to individual investors, I say, that's not your problem. That's an institutional problem. If you're benchmarked on a quarterly basis to the cap-weighted S&P and you don't own those big contributors, then you are hindering your performance. But the contribution to return comes as a product of the price return times the cap equals the concentration. I mean, it equals the contribution to index weights. Of the top 10 best performers in the S&P this year, none of them are in the Magnificent Seven. Top 10 best performers in the NASDAQ, not only are none of them in the Magnificent Seven, I bet you most people have never heard of any of the companies. 4 of the 7 are pretty meaningfully underperforming the S&P 500. You are not, as an individual investor, you're not benchmarked against the S&P 500. You don't have to take that concentration risk. There are other opportunities to do well from an individual stock performance, without taking the risk associated with overly concentrated in those names, because they're not the best performers. They're just the biggest contributors.
Let's just kind of continue down this thread. So if you're an investor and you're looking for a broadening out in the rally, like what things would you look at? And then that's the first question. And then within that, what are you seeing this year beneath the surface within sort of sector performance? So those are 2 things that I think are related at the hip here.
Yeah. So the rally off the early April lows, as we already touched on, was very much retail trader centric. But the areas as represented by that cohort that have done well are decidedly down the quality spectrum. So heavily shorted, the meme stocks, retail favorites, non-profitable tech. What you would look for like a broadening out or a healthier market backdrop would be less leadership in those low quality areas and more of a connectivity between sort of higher quality factors and fundamentals and price performance. And it's not that the high quality is underperforming. They're just underperforming those lower quality, crowd favorite type of areas. So one way to think about positioning as an individual investor, to use more trader lingo, and I don't consider myself a trader, but kind of fade the low quality aspect to the rally, but lean into higher quality. You may not benefit if the market continues to rip higher, because you might still see those lower quality areas. You're still going to do well because we do have more connectivity between fundamentals and stock prices. We have the return of the risk-free rate. There's more price discovery. So you'll still do fine in those areas, but they become important anchors to windward, assuming we, at some point, which we will at some point, have another pullback phase or another corrective phase. And that's where that high quality bias tends to really serve you well. And you don't have to look all that far in the rearview mirror to see the last time that happened. It was the period between mid-February and early April when the Mag 7 were the underperformers and tech was the underperformer. And you found that the quality, strength of balance sheet and interest coverage and strong free cash flow and stable profit margins, those were the segments of the market that in relative terms did well. So you might limit some of the upside in a continued, FOMO type melt up, but it's a way to get sort of fundamental underpinnings in your portfolio that can also serve as a bit of a ballast when we have the next pullback or corrective phase.
Everybody's other favorite sector, AI, in giant air quotes, as if we can somehow reduce it down to a single sector. How do you view AI in comparison to other previous technological breakthroughs? How are you thinking about this? We talked a bit about it last time. Where are you at with AI?
Yeah, and you know what? I didn't specifically answer the second part of your prior question around sectors, but this is a way I can weave that in. So, AI is real. The growth is exponential. Most of the companies tied to it from an infrastructure, from a picks and shovels, from a first mover advantage are real companies with massive revenues. And that's where I would make an important distinction between this era and say, the late 98 to early 2000 period of time where, yeah, there were some big quality companies right at the heart of the growth of the internet that are still with us today. But a lot of the hype and enthusiasm and best performance was in the nonsense companies, the, not profitable, never have a chance to be profitable, valued on, stupid things like eyeballs. So I think there's a little bit less of that sort of silly season than was the case, but that doesn't mean you don't have to have periods of consolidation from maybe a valuation excess perspective. That's frankly exactly what happened from, February to April is many of the AI related stocks and in the periphery got hurt disproportionately because it came at a time where really robust growth rates were decelerating a bit to still strong growth rates, but direction of travel matters. I think one of the mistakes that investors often make when trying to connect the dots between fundamentals, economic data, earnings data, and what the market is doing or what individual stocks are doing is they think in sort of good versus bad, strong versus weak terms, as opposed to better or worse. And I often say better or worse can often matter more than good or bad. So that deceleration in forward earnings expectations at a time where valuations were incredibly rich, you had to have this sort of 2-month reset. And I think we could have more of those. You also had the DeepSeek news that questioned the massive amount of spend by the key players in the United States and whether that actually was as protective a moat as was thought. Turns out the spend is still going to be there and it is still a pretty protective moat. But what I think DeepSeek also brought about, and this comes into play in where sector performance has been. So the best performing sector this year is industrials. One of the other best performers, about tied with communication services, which is also a sector that houses a lot of AI related names, is utilities. So you've got almost these peripheral plays on AI for the data center build out and the power generation needs. And that was an expectation we had in our full year 2025 outlook piece that we wrote, that we were probably going to see a shift from away from just sort of the core infrastructure names associated with AI to more of the build out. And then maybe I think the next step is an increasing focus across the spectrum of sectors and industries, with the basic question being, hey, you, CEO of company, ABC, how are you using AI? How is it benefiting your productivity? What does it mean for your workforce needs? Is it allowing you to move into areas that you haven't been in the past? Is it shortening the time to get things in production, et cetera, et cetera, et cetera? So I think we've already made that not shift, but we've widened the net to include the data center build out, the power needs, and increasingly it will be about, okay, how is the world using AI? And so I'm very enthusiastic, but that doesn't mean we don't need valuation resets to allow earnings to sort of catch up to, at times, extremes in valuation.
Liz Ann, this has been great. You always come with your A game, which we really appreciate, and I know our
Thank
audience
you.
does too.
So kind. Thank you.
Just one last closing question before we let you go here, which is, what is the one thing you believe about investing or the markets right now that you think most of your peers would disagree with you with?
Well, certainly my peers in traditional Wall Street feel that there's some value in year-end price targets. I think it's such a dumb exercise. And for our client base, which is all individual investors, we don't do it because I don't think it makes any sense. I mean, I use this as an example. Somebody at the beginning of 1987 could put a price target for the end of the year about where the S&P was trading at the beginning of the year. And if the commentary associated with that was, market's not going to do anything this year, nothing to see here, they might have said just at those 2 points in time, boy, I nailed it. But the ride along the way was anything but, even. And the exercise of the constant adjusting of year-end price targets, and maybe that's a way for institutions to judge one strategist versus another, for strategists themselves to, get on the pages of II or be able to pat themselves on the back for saying, I nailed the year-end price target. But for individual investors, I just don't understand the value. So, unless Schwab, the company, all the way up to Chuck himself, decides that, hey, we do want to do this, and that's never been the case in the past. That's the one thing I don't do, and I'm happy about not doing.
That's great. Thank you, Liz Ann. We really appreciate it.
My pleasure. Thanks for having me.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.